Hello students. Our topic today is Real Estate Investment Trust (REIT). Before we start our lesson, let's review together the learning objectives of the topic. At the end of this chapter, students should be able to explain the tax treatment on REIT and the distribution of income to unit holders. Second, students are also able to explain the responsibility of REIT based on Section 109D. Lastly, students are able to compute the income tax payable of REIT. Introduction. A REIT or PTF is a trust that is constituted as a collective investment scheme. It invests primarily in a portfolio of income-generating real estates. The government had introduced a special tax treatment as an incentive to promote the growth of REIT or PTF in Malaysia effective from the year assessment 2005. Rental income received by REIT or PTF from its investments in real properties is treated as gross income from a business source according to Section 4. Special tax treatment. First, deductibility of expenses. Expenses wholly and exclusively incurred in the production of the rental income are deductible against that rental income. Second, capital allowance. Capital allowance is restricted to the adjusted income from the letting of property for that year of assessment, and if there is no adjusted income or insufficient adjusted income to absorb the capital allowance, any excess capital allowances is disregarded. Tax exemption distribution of income by REIT or PTF, with effect from year assessment 2007 subsection 61A in bracket 1 of the Income Tax Act provides that a REIT or PTF is fully exempt from tax for a year of assessment if it distributes 90% or more of its total income to its unit holders in the basis period for that year assessment. Distribution of income to unit holders. A REIT may make a number of distributions to its unit holders any time in the basis period for a year assessment. A grace period of 2 months from the closing of its account is allowed so as to distribute income to unit holders in order to qualify for tax exemption. Deduction of withholding tax pursuant to Section 109D of the Income Tax Act, where a REIT or payer that is exempted from tax under Section 61A of the Income Tax Act, which is deemed derived from Malaysia to a unit holder other than resident companies, the payer is required to deduct withholding tax at the rate applicable to that unit holder. For resident individuals, non-resident individuals, and foreign institutional investors, the tax rate is 10%, while for non-resident companies, it is 24%. However, withholding tax is not applicable to resident companies. Diagram below shows an overview of the distribution of income to unit holders. That's all for this topic. See you soon later for another topic.